Let's take a closer look at how Astra 5 performed in the latest distribution period. Here's a quick summary of the Astra 5 bonds as of the third distribution date. Some key highlights for this period were that interest was paid to bondholders on 21st December last year. The portfolio had a NAV of 1.382 billion. 47 million was set aside as reserves. As in Astra 4, the Class A bonds have a 5-year term, and this amount is set aside every 6 months to redeem the Class A bonds at maturity. And lastly, the maximum LTV ratio of 50% was not exceeded. The next two slides show Astra 5's portfolio. The portfolio has a 63.7% exposure to the US, 19.5% to Europe, and the balance in Asia. The buyout strategy also continues to make up most of the portfolio NAV at 77.3%. The top 3 PE fund managers were KKR, Silver Lake Partners, and General Atlantic. And the top 3 fund investments were Silver Lake Partners Fund 4, General Atlantic, and Yun Fong Fund 2. The weighted average fund age of the Astra 5 portfolio is slightly younger at 6 years, and it is also in the highly cash flow generative stage. This slide shows how the portfolio NAV has changed since launch. As mentioned earlier, due to the COVID pandemic, markets were impacted negatively in the first half of 2020, resulting in a drop in valuation at the second distribution date. In the subsequent period, the portfolio saw valuations rebound, and the total portfolio value has appreciated above pre-COVID levels, reflecting the broader market recovery. The total value now stands at 1.741 billion. In terms of cash flows, in the latest distribution period, 187 million distributions were received from the PE funds, while 22 million was called. The portfolio value also appreciated by 317 million. These cash flow movements resulted in an ending portfolio NAV of 1.382 billion. To better understand the distribution waterfall for the current period, let's look at the distribution waterfall for the previous period. During the second distribution period, there was 76 million available cash for the priority of payments. After paying 3 million for taxes and senior expenses, manager fees, and credit facility fees, and 14 million for bondholders' interest, 47 million was paid to the reserves account according to the priority of payments. In order to determine if more cash is needed to be channeled into the reserves account, the LTV test was performed. We have earlier gone through the computation of LTV in Astra 4. As such, I will not repeat it. As you can see on this slide, no additional cash needed to be paid to the reserves account as the LTV ratio was 41.5%, well below the maximum limit of 50%. Similar to Astra 4, the sponsor decided to waive the 12 million due to itself and channel it to the reserves account given the uncertainties posed by COVID-19. As you can see from the calculations in the table on the left, this additional 12 million lowered the LTV ratio even further from 41.5% to 40.6%. Now that we have covered the priority of payment for the previous distribution date, let us look at the priority of payment for the current distribution date. As a quick reminder, the structure received net distributions of 165 million during the period. In addition to this, there was a beginning cash balance of 15 million, while the same amount was retained for the next period. This led to a total of 165 million in available cash flow for the priority of payments. First, 3 million was used for payments of taxes and senior expenses, manager fees and credit facility fees. Next, 14 million was used for interest payments to all bondholders, followed by 47 million being paid to the reserves accounts. In order to know if more cash needs to be channeled into the reserves accounts, we must perform the LTV test. First, we identify the total portfolio NAV at the end of the period, which is 1.382 billion. Next, we calculate total debt B, which is 605 million. We then subtract C, the reserve accounts balance of 106 million, and D, the 47 million that was just paid into the reserve accounts this period. Lastly, we take the total net debt, which is B minus C minus D, and divide it over the total portfolio NAV, which is A. As you can see, the ratio was 32.7% and did not exceed the 50% mark. Since no additional payments to the reserve accounts is needed based on the LTV test, cash can continue to flow through the priority of payments, and 101 million was paid to the sponsor. With this 101 million, the sponsor would have received a cumulative total of 235 million. When this amount exceeds 407 million, the 0.5% bonus redemption premium will be paid out to Class A1 bondholders upon redemption. With that, this ends the segment on Astra 5's performance. Thank you.